Dolat Capital joins us now. Rahul, good morning. Thank you for joining us. Okay, the losses are coming down despite the fact that post RBI guidelines, their money-making business, which is aggregation of loans, that will come down. Are you surprised with the Paytm's earnings trajectory that they are on course to reduce their losses and become profitable soon despite the new guidelines?
Yeah, of course. Lending business is definitely the most profitable of the lot, but that does not mean the other businesses are not profitable. We need to understand that this business is a platform business. So if you see more and more scale, all the businesses become relevant over a period of time. We just say that lending business is more profitable because we don't ascribe customer acquisition cost to that lending client because he was already a payments client. But so in a way, you ascribe the cost of acquisition in some other line item while you ascribe profitability to one. What is important in this business is how much it can scale in terms of engagement. So if you see the growth this quarter, it is higher than the first half on a YOY trajectory. So that says that there's a lot of use cases. One of the use cases was not doing good, but they have many more things to compensate from. And as a result, we are seeing better than expected results.
Better than expected results, but the stock has gone from 620 to, let's say, current levels of 720, 730. So do you think this entire result surprise is already in the price?
So if you follow the entire path, there was this lending caution that they highlighted in the month of December. And that time the stock price was around 850, 880 level. It came all the way to 600 later on. So that was because there was a lot of ambiguity around what will happen to the profitability path because of this event. Now, since some of those clarities have come, and now with this result, we know that there could be an impact, but it's not that significant. The most of that loss or the price correction has been recouped, and now it's barely like 10% down from where it started falling. So it's not gone up, rather it has fallen. The fall has reduced to that degree. And that's why as earnings will progress, the stock have significant room for upside.
Rahul, wanted to get in your take as well, given that this time around in the quarter gone by, there has been a focus on cost reduction. For the first time, the employee expenses as well, ex-ESOP, they have been flat sequentially. Is that a sign of the fact that the company is really taking cognizance of the overall heightened costs?
There are two aspects to it. The ESOP part, which you said, is a natural progression which has to come down because that's how the accounting works on the ESOP, that it is front loaded and then it will come off. So rather you would see on a next 4 quarter basis a dramatic drop from the current run rate that you see. So that is on the ESOP part. If we look at the employee cost, otherwise also that's kind of stagnant, and they highlighted during the quarter that they are leveraging a lot of AI out there to benefit out of those kind of a synergy. But more importantly, even if it's a cost cutting measure, which there could be some aspect to that as well, what we need to understand is that basically the company is committed towards the loss reduction every quarter, and they are on a genuine path of profitability. Of course, one need to be careful about that, whether this kind of cost cutting measure can potentially impact anything on the growth side. That will learn over a period of time. But for now, we could say that their commitment on loss reduction or path to profitability look just on the track.
Okay. So what would you advise to our viewers? Add at the current levels or wait for like a bad patch like we saw a month ago, month and a half ago when the stock slipped to 620? That's the time you should be a buyer.
No, of course, that was an extreme reaction, and of course, anybody who got chance and found it as an opportunity rather than a risk, significantly benefited in a 1 month. It's more like a 30% return for them. But irrespective of that, I would say it's like normalization of environment because because of that change, there was close to 8 to 10% kind of an earning cut that even we did to our estimate, and now the price is almost like 10% down from where it all started. So in a way, now it is fairly priced from that event risk perspective. So here on, I would say the earning growth, as earning growth come, in the stock should do well. This price can be a good price for somebody who is looking from a long-term perspective, because probably in 2 to 3 quarters from now they will become PAT positive. And if that happens, we have seen how the likes of Zomato and Policy Bazaar have related closer to the profitability, so that the ambiguity of that business goes away and people ascribe far more value when it is profitable, actual profitable rather than profitable in the forecast period. So that kind of a uplift can happen in the stock over next 2 3 quarter. So we think this is a good price for anybody who is having a slightly higher horizon of holding.
Rahul, good to have you on the show. Thanks as always for taking the time out and speaking with us today and taking time on a Saturday. I must point that out.